everyone. On the property show today, the focus is simple. How does one manage a whopping 2% jump in home loan interest rates without busting one's budget? Here's the math of why this discussion is an important one. Now, 6 months ago in April 2022, on a 50 lakh loan for 20 years, your interest rate was about 6.9% and your EMI was 38,465 rupees. From 1st October, home loan rates on a 50 lakh loan for 20 years are averaging 8.75%, making your EMI 44,186 rupees. Now, an increase in your equated monthly installments is 5,721 rupees. And if I do the math, your EMIs are now 15% costlier. Let's get the experts to weigh in on the impact and tell us how to cushion this blow. Sanjay Dutt, MD and CEO of Tata Realty Infrastructure, Amit Kukreja, Family Wealth Advisor, and Samantak Das, Chief Economist, JLL India, are with us. Gentlemen, welcome. Sanjay, the festive season had just begun. We did this show about the upbeat mood, and now we were kind of hoping that banks and housing finance companies will probably let this festival season pass by before announcing the hike, but that's not happened. I mean, HDFC, SBI, ICICI, you name it. And within hours of RBI raising the repo rate by 50 basis points, they actually also increased the rates. How much of it is this a mood buster when it comes to sales velocity?
It is a concerning trend, Manisha. However, the journey started with salary increments upwards of 8 to 10%, in some cases 15%. And therefore, some impact has already been absorbed to some extent. And the remaining impact, we as a developer community, we actually rolled out some very timely schemes to take the impact out of the recent increases. But if it continues in the same direction beyond a particular point, and if the job confidence dips, it will be concerning, Manisha, in that case.
Samantak, if it continues in that direction, so we are still in single digits. I remember taking my home loan about 11 years ago, and I took it at 10%. So double digit definitely hurts. What's your prediction on further hikes? As an economist, do you believe that RBI may not be able to rein in inflation without actually raising rates by a few more percentage points?
Manisha, it's very simple. Macroeconomic parameters is definitely a very strong influencer for home buying decisions. So to that extent, as Sanjay said, that the policy rate going further would definitely impact the home buyers. Now, a couple of things I'll just highlight. One is today we are at on 190 bips rise in the last 6 months. So we have seen your interest rate moving up, and it's around 8.5, 8.6 on an average. So it's inching towards the 9%, still lower than what we used to have 8-9 years back. So that's one. Second is very important is what is the forecast of RBI about inflation, which is around 6.7%, higher than the upper target of inflation. The target of inflation, that's around 6%. So they are actually forecasting 6.7 till March end 2023. So keeping that in mind, as well as the Fed rate hikes and their stance going forward, we believe that there will be another 40 to 50 bips rise in the policy rate, and thereby again another 25 to 50 bips rise in the home loan interest rate. So to that extent, I believe that it may go to the today 5.9. It may go to 6.3, 6.4. So we are back to 2016-18 repo rate. So,
okay.
But to that extent, Manisha, double digit, I don't think it will go right now, at least in the next 2 quarters. And very important, another point I want to bring out to the entire audience is this EMI. As you said, it's 9 to 10, sometimes 15% increase in EMI. But any home buyer has an effective loan tenure of 10 to 15 years, even if the loan tenure is 20 years or 25 years, because there are repayments. So if you see that there are up cycles and down cycles of EMIs, right? So ultimately, it balances, and the impact on EMI increase is not so great on the home buyers. So that is one thing. Arithmetically, yes, in the last 6 months, I think 8 to 9% rise in EMI. Okay.
Okay. All right, Samantak, let me come back to you. Let me get Amit's first reactions there. So you're saying that we will not see double digit as of now, at least till March 2023. At best, we would probably see another 50 bips hike in repo rate, which means home loan rates would also probably go up by a similar amount, taking them up to about 9.25%. Amit, my question to you is that, look, we can say that it's not a very big amount. To me, 5,000 more EMI per month for a middle class family in India is not a small amount. How do we cushion this blow?
Yeah, I mean, it's a tough situation, Manisha, especially families who just realize that buying a house is very important for them, especially during the COVID days. So they will have to go through the planning exercise with their advisor or somebody, with their spouse or somebody else who they believe are the experts, and figure out how do they pad up for this sudden change in the EMI. Most likely they would go for increasing the tenure of the loan rather than allowing the EMI amount to go up to accommodate this impact of the changing interest rate. So it's a tough phase for them to figure out, because they just decided to buy the house a year ago or maybe a couple of years ago, and now suddenly they have a sudden increase in the EMI amount. So most likely they'll be going for increasing the tenure for the existing home loans that they have because of the interest rate hike.
Is that, but do you believe, I mean, you're dealing with a lot of families and you're counseling them. Do you think that those who are probably sitting on the fence may push out that decision, or that's not going to happen? COVID's made everybody realize that, look, first home is non-negotiable. Amit, I'd like to get your feedback from your customer interaction and client interaction on an overall wealth management perspective.
See, definitely folks who have been wanting to buy a house are suddenly now going to take a pause. Is this the time to buy? Is this the right time to enter the market? Even if it's a first house, they would rather wait for two things. One, they have seen that the real estate prices have gone up, particularly in the metro cities. So they might believe in waiting for some time, because they might believe that the prices may come down, and also the loan rates may also come down. So there is definitely going to be some pause for the people who are fence sitters. For folks who have already jumped in and bought the houses, they have no choice but to increase the tenure if they're not able to accommodate the increase in the EMI amount due to the rise in the interest rate.
All right. Sanjay, now prices have already gone up. You know, if you look at the national price average, then you see that prices haven't gone up. But everybody knows that in good locations, by good builders and developers in metro cities, prices have actually shot up by as much as 15%. Now you have a situation where your own cost of borrowing is going up, isn't it? So far, it was just commodities which you'd felt the impact of. How much will you be able to cushion or absorb it without passing on additional burden of increased prices to the end customer?
Clearly, Manisha, at what stage of life cycle the project is, the developers will be able to take a call. Okay. If it's at a very early stage of development, they will actually absorb some costs because they want to bring cash into the books and reduce their debt exposure. But if you're towards the fag end of the project, Manisha, I can assure you, the investors and the buyers know that it's better to take this interest hit than suffer from price rise, because I'm expecting another 10 to 15% price increase in next 12 months, not necessarily because there is limited inventory, which is also factually correct, but also because the cost increases, like you mentioned, the cost of capital, we may not be able to sustain longer. So therefore, it has to be, to some extent, passed on.
Samantak, Sanjay mentioned inventory levels, and I've looked at inventory levels. Yes, there was a dip in under construction inventory for sure. Ready inventory, we've been at low levels for quite a long period. Where are we? But because you suddenly see so many project approvals now coming through in Mumbai specifically, and in other parts of the country as well, in the top tier cities. Do you think that the supply levels are comfortable enough for developers to pass on an increase in cost, or supply gut is coming as well?
See, Manisha, I mean, I think the cost escalation on the part of the developers, as Sanjay said, is correct, because developers are also price takers.
Of course.
So to that extent, they have to pass on at certain level. But when we see the market, I think it's quite at an equilibrium position as far as unsold inventory is concerned, because the big numbers that we see in the market about unsold inventory is at various stages of construction. So it's better to see years to complete and years to sell. Today, when I analyze my data, the years to sell has come down from 4 and 5 years to now 3.2 years as of September 2022. That means, the sales have increased in the last 9 months, and the launches have also increased, but sales rise is quite faster. Now, that gives basically a very equilibrium position of the market, the physical market, because your sales to complete is around 4 to 6 years. Your sales, year to sell is basically 3.2 years. So in that way, I don't think there is much of pressure on unsold inventory on the developers. To that extent, I think developers might take a call to slightly increase the price.
Mm-hmm. Okay, so price rise also coming in because developers' cost of funding is going up. Amit, last time, we had a home loan rate hike very recently and we did a discussion on a similar topic. And Mr. Niranjan Hiranandani mentioned a very important point. He said there is research which shows that Indians are very good savers and that rarely does an Indian family actually last out its loan for the entire tenure period that it's taken the loan for. Most families end up prepaying it. Now, would you believe that, this might also be the time to tighten your belts and look at probably prepaying some chunks to shelter this impact? What's your opinion on that?
So folks who have surplus money are very likely to take that call. They will do the prepayment because they want to absorb that impact of the rising interest rate. But look, people who are buying the house these days are the ones who are basically first-time buyers, and they are the ones who have recently realized their capacity to buy in a real estate and to have a self-use home. These are not the people who have sufficient money to make any prepayment. So they are most likely going to be the folks who will be accommodating this impact by increasing their tenure. So the stuff that you are suggesting is very likely to happen, but I think majority of the buyers are not the ones who have a lot of money sitting aside, which they can use for prepayment.
My other question is also there is this choice of refinancing, right? Because some banks have raised it all the way to by 1.9% to 2%. Some banks have not raised it because home loans still remain one of the safest assets for them, and there is a lot of aggressive selling or wanting to get customers on that front. Amit, at what percentage does it really, or difference of percentage in home loan interest rates, does it really make sense for someone to actually move to another bank of housing finance company? I would say bank, HFCs are generally higher.
Yeah. So I think a couple of things matter the most. One, the lending institution's credibility. Are they really good players in the home loan financing or the home loan as a lending institution? Number two, what is the alpha or what is the differential that they are getting by doing the switch from lending institution A to lending institution B? If that switch is about up to 0.5%, I don't think that's going to make a lot of difference, because we also have to consider how much of the loan has been paid back through the EMIs and how much of the loan amount is remaining that is yet to be paid, and transferring that to a completely new loan which is starting from scratch. So you need to do that fair calculation of option A versus option B, even if option B is sounding cheaper than option A. So it's a mathematics which needs to be done with all the facts on the table.
So there are no easy answers or straight answer, but don't consider it if the difference is less than 0.5% is what I'm hearing. Sanjay, final question and very quick wrap out. We just started seeing investors move into the real estate market. In this scenario, when real estate is good against inflation, you also have cost of financing going up, and investors do take finance to buy multiple real estate, and you have a likelihood of prices going up. Is this a deterrent for investors, or do you believe more investors enter the market? Is there some kind of clarity on that?
Manisha, investors always calculate their return after adjusting the risks. And I think risk-adjusted returns in real estate are extremely attractive. And I think going forward, they will see further appreciation in good projects, because now they can really separate the good developments from not so good developments or developers with track record, and they know what sells better and what doesn't. So I think they are far more informed, and this would not be a deterrent.
Sanjay Dutt, Amit Kukreja and Samantak Das, gentlemen, thank you very much for joining me. Interesting discussion as always. And of course, like we all agreed on, that yes, short term it is a deterrent, but long term you just have to brace that impact. The best way to ride out the rising interest rates on home loans, try and make some prepayments every 6 months or so if you do have surplus. So less Diwali shopping and more home repayments or home loan repayments. And of course, if that's a hard one for you, extend the loan period to the maximum that the bank or housing finance companies will offer you, so your EMI remains the same. When we return, urban farming, a new way to own and invest in land. How does that work? We'll tell you. Stay with us.